Hi, Graham. Good morning.
Good morning.
Hi, how are you?
Yeah, good, thank you. How are you?
I'm well, thank you. I'm very well. I'm very
Good.
well. How's work?
Uh,
You seem to have the most hectic schedule of all the students in this group.
well, it's just mad at the moment because my assistant has been furloughed and I don't know when she's coming back, so there's no one else to do my work. Um, so yeah, when it's really busy, I just have to go in, and it's a bit of a
Totally.
nightmare. But today
Totally.
is actually pretty dead, so I
Oh,
can
good.
it's fine.
Oh, good. Hi, Natalie.
Hi,
Hello.
Ian. Hi,
Hi.
Graham.
Morning.
Oh,
You
good.
okay?
Yeah,
Yes,
good.
no,
Thanks. How are
sorry.
you?
Yeah, not
I'm
bad. Oh,
sorry. Go on, Natalie. You were
oh
saying?
no. I was just rabbiting on about, it's just getting back to a bit of normality now, isn't it?
Yes,
Really?
yes, 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 yes. Finally, yes, there is. Yes, we are seeing definitely things are getting back to normal. Things are getting back to normal. I was just chuckling at Graham's. It reminds me a little bit of practice where where Graham said that because his assistant. Hi James. Hi Dudley.
Morning. Hello.
Good morning. I was just chuckling at the fact that Graham said that because his assistant had been furloughed, um, he had to do his work, something along those lines.
It wasn't quite like that, but
sorry,
yeah.
sorry, let me rephrase it. Um, I can't rephrase it. I'm not sure how else it's just the way you said it.
I think it's my type of work that they can't do. So
Right, of course. Yeah,
yeah,
absolutely. Yeah.
not just all my work.
No. Oh, good. It's so funny. It's good. It reminds me a little bit about like like because what we when I was I don't know um, James, I don't know how it works. Typically, maybe a team, you would have maybe one assistant who helped maybe two teams, or one assistant to a team. Maybe, and a team would have about maybe six people. Where when I say six people, you might have, or seven people, where you have an audit manager, two or three auditors, and two or three audit seniors and two or three audit juniors, something like that type of thing. And because he or she did so much for us, whenever they were off sick or they were not available, it was just like we couldn't do our work. We're like, oops, I don't know where that file is. I don't know who that is. Who sent for the information? Did she not send? Where is it? Where is she? So critical to everything we do. Cool, great stuff. I hope you're all well. Um, let's see, Hannah. Let me just make sure Hannah's not trying to join us. Um, cool, great stuff. No, she'll probably join us in a second. I know she's been having a lot of moving issues and things like that. But great stuff. I hope you're all well. We're good. We're carrying on. Today we will carry on. We will finish off looking at audit procedures with those slides, and then we will jump into. We will just do some questions. Really, I think again, you'll notice when I do the questions today, when I go through the questions, that where I think audit is fair is that what I'm doing is giving you this general overview of how we treat a lot of these balances. Um, in effect, what you have to do is you have to apply it to the question. And when you now read the question, you will see that from the point of view of almost the general idea of, when I say checking or looking for something or trying to find out why, if you almost imagine it was your business and you had no accounting knowledge, almost the same procedures you would carry out are very similar to what we're doing here. So in application, it's actually slightly more human or normal, and everyone kind of goes through that process. But although we have to go through sort of the standardized knowledge, and that feeds into our understanding of what to do, then getting technical, applying those AEIOU type language analyze. So you're constantly analyzing. Don't think of that as some kind of weak form of substantive testing. No, it's a very powerful form of substantive testing. So every time you think that I'm going to compare last year to this year's, if you like to look for fluctuations, that's a mark right there. So you want to have that at the back of your mind. Don't think I haven't physically done anything. No, you just carried out some figures. And when I say, I mean, excuse me, when I've always thought that the good thing or the reality, and I know I'm speaking out of context now, the reality of practice is that there is no manager or there is no one who wants to just see that you just write, oh, gross profit margin increased from 10% to 12%. You know, that really didn't help anyone. What they would like to see, because of course your training, whether your training AAT especially, has forced you to break down the components of revenue and its related cost of sales. So you literally can calculate the gross profit margin of each individual stream, if you like, and then compare to the next year. And then you can truly see fluctuations and then ask questions as to why did this product not sell? And then you can see how that feeds straight away into questions about inventory and closing stock or potential bad debts. So it really becomes, it means the manager can go ahead and ask about individual clients or individual cases, if you see, because it's structured as opposed to this general overview. So what we're definitely, so I'm almost telling you that the marks in audit are where you're showing that I've broken down this thing I'm looking at, or I'm trying to break it down, even as close, even up to inventory, which means that you can almost drive your own marks. There is no standardized mark. It's the case that if you're saying, listen, what I would do is I'd literally break up inventory into high valued items and low valued items, or high, mid, low, if you like, or ones at risk of going obsolete, and then focus my attention there. You're getting the mark, because, which is why all of us as auditors might do it differently, because we just want to make sure that the valuation you have at the bottom there on your statement of financial position is as true, as fair as possible, by me focusing on the most important balances or section of the balance that's at risk. And then when you think of it that way, because you don't have time to look at everything, so you almost have to take that. And then what ends up happening, like in all practice, is that managers feel, oh, they can leave you alone and you get on with your work, and then suddenly you now, oh, here she is. Then you are now able to carry on managing your own, if you like, audits, so to speak. Hello, Hannah.
Hello.
Hi. No, you're all right. It's okay. I hope you're well. Cool, great stuff. So let's kick off. Let's finish off the PowerPoints that we were looking at, and then we'll go into a question. Sorry, in case you had, I think I checked my mail on Wednesday, I think, but I won't say homeschooling. I was attempting to homeschool yesterday, so I haven't had the chance to look at my mail. Actually, I was going to log in this morning, but I haven't. And what am I teaching right now? We're still on fractions, so we haven't left that yet. So that's what I was doing yesterday. So if you've sent me your work, that's fine. But we're going to go through those questions, at least 2 of them, and let's see. Cool, great stuff. So let's let us go to, so we were on our slides, and I think we were, let me see, we must have just been, yeah, I think oh, sorry, I'll share my screen with you in a second. Let me share my screen, and share screen. Here we are, share. Yes, so yeah, I'm sure we had covered receivables. I'm going to start at payables. I don't remember if I'd covered that, but we'll just go through that. Again, the AEIOU, if you're following that principle in general and you're coming to use your own language, that's great. That's what I really want. I don't want you, because you will forget if you start cramming these rules. They're not rules, they're just guides. And then when you now, in your mind, kind of work out what you would ordinarily do. So like anything, like any process of trying to verify anything, you want a list, you want to obtain, and that's your starting point for anything. Don't take it for granted. Obtain the list, if you like, or obtain, if you like, the disclosures or whatever it is, obtain the information. You need to get that information to just verify for yourself in the first place whether everything is on there, just the starting point you're going to be working with, or just to add everything up. You see, because you see, here's the point. Again, I keep verifying this. I'll keep highlighting this. Let us not assume that the statement of financial position and the statement of profit and loss has come through the accounting system. No, you might have had two very different accounting systems. You might have had one system that prepares the accounts, the management accounting system, and a completely different system that prepares the final statements. So there is no guarantee that, if you like, both will be correct. No, all you get given is the statement of financial position. What you now have to do is to verify that the total figures that are on the actual system, the management accounting system, make up or are equal to what's on the statement of financial position, which is why you see this thing here. Oops, sorry, my pen. Which is why you see this thing here that tells us to obtain a list of trade payables. And you and I know that the list of trade payables would have come from aged trade payables. Doesn't matter what system you're using, accounting system, literally go to that report, boom, it brings it out. And now you can almost, your first task is to link that or verify that to what's actually on the set of financial statements, right? And then again, like I say here, what you then really want to do here, so I'm talking about payables now. So with a number of things here. So here is just verifying that and then just reconciling. Of course, what we also have, oops, sorry, all these notifications. So what we then have, of course, is that the good thing, I think, I'm just going to throw this, I did talk about it last week. I mean, please, you can put on your mic to answer this question. I know Graham wasn't here, and I don't think you've watched the highly spectacular 2.5-hour video we've uploaded to.
I haven't yet. No.
That's fine. I'm being facetious. I mean, I wouldn't expect. I mean, there are. Yeah, it's fine. Although I do have, Natalie, you noticed once, there's someone, and I think it's a spam. So as soon as I upload a video, this person goes on and says, "Wonderful video, brilliant," or something like that. I think it's spam because yeah, and I think they want to sell you something. I don't know, because it always goes on, "Brilliant video," but literally it was 1 second. How could you watch this very highly interesting video on audit to suddenly know it was a brilliant video? But last week I said that, what did I say was the best tool for verifying payables? I mean, get the list. Sorry? Perfect. Supplier statements. I mean, you write that, you've probably got half the marks of everything, because as you can see that, I don't mean this in a bad way, but this is how when I did my audit work, everything I always said to anyone I would work with or as audit trainees were coming through, and we've talked about it in evidence, in sufficient and appropriate evidence. Sufficiency is an amazing thing. I mean, I've always loved the term sufficiency, because sufficiency, I think, has the false impression about meaning volume. No, it doesn't. I mean, we've highlighted that several times. I mean, there is an element of volume, but if you can get, and we highlighted, the best evidence you can get is third-party external evidence to prove what's in the books. I mean, that's just brilliant, because you cannot technically influence a third party, which is why a bank statement is sufficient evidence. It's one piece of document that's externally produced that's confirming what's on your cash book. Brilliant. As is a supplier statement. So, I mean, it's all well and good if I can get all my supply statements, and this is as jangled as the language sounds. An examiner knows gets what you're saying. If I say that I will get all the year-end supplier statements for all the suppliers on the list, on the supplier list, and add them all together and verify them to the ledger. And if they're all equal to that, well, there you go. I'm sure that the figure that the person is declaring on, I mean, forget accruals for now, but I will just take that first of all as being equal to that. So that I think that probably that's your best one here. Okay, great. So let's look at some of the others. Of course, there are other things you should do that we do as well. So we reconcile the total of the individual, which is what we're really saying here. you're reconciling these individual payable accounts, of course, right? The supply ledger, the trade payables ledger, with the control account. You're actually looking at the the control. I mean, that's a control again, isn't it? The sales ledger, sorry, purchase ledger control account is a control to see whether the organization really has a way of managing and looking to see how it's to see what the issues are, if there are any, with, if you like, its trade payables. So doing that reconciliation is a control, if you like, as well. So this is what I was saying, obtaining supplier statements and reconciling them, looking for any differences. You see, because if there are any differences, then we can investigate. Then I also mentioned that probably the next level, which is just as important, which you must write if you have this type of thing, we talked about it on receivables, is the fact that we send out letters. They're referred to as circularizations. So we send out circularizations to these suppliers and we ask them, please, can you verify? Because again, it's third party and external. So again, like I say, the audit does have some fairness because there are only so many balances you can get asked about. And therefore, you know straight away that as long as I'm trying to get external evidence, however you write it, you're all right. Before we start analyzing, you see, so they're marked everywhere to pick up. Okay, great. So, so circularizations are, if you like, are important as well. There. So. So here we are. Here's some other things that are important. So inspect after-date payments if they relate to the current year, if you like. So really, I guess the point here is that we do want to test existence to a certain extent. So what you should really do, a common test really, is to, sounds a bit silly, but you might just assume, you might wonder, why would anyone, of course, well, when I say tested, you're testing for completeness and existence. So what you want to do is you want to make sure you look, for example, say in a 12-month period, you want to pick, say, 12 invoices, purchase invoices, right from the order, right from the get-go. Literally pick up 12 orders, maybe 2 each year, 2 each month, and literally follow them right through to when you pay for them post year end, if you like, really to see if these things really occurred. You know, we remember we said that, well, that was purchases, we'll talk about that there. But for payables, we also want to sort of just see if this thing actually exists, so to speak. Right, and I mean, I guess you could just, so really in a sense, any inspecting after-date payments means that they do exist. Then, of course, there's the question of accruing. So, of course, what you want to be doing is you want to be looking at, and we will see this under more accruals, although the term accruals tends to talk about more non-payable, non-trade. But what you definitely want to do is that there might be invoices post the year end. So really, so let me just kind of get it into the way you think about this, so you can really see how this works. Now, when goods are received, we're really trusting the client to have good systems. Goods dispatched and goods received are actually the signal for sales and purchases. So we say you have made a sale when the goods have been dispatched. It's not, it really isn't about whether or not you've sent an invoice or not. It's about whether or not the goods have been dispatched. So that's really the true point of a sale. The goods have been dispatched, and then therefore the client is on his way to receive them. They're no longer yours. You have exchanged, just like when you receive a good. So when goods have been received, that is the point. At that point, you have made a purchase. It's not really so much about whether or not the purchase invoice has been received or not. So in your audit mind, you're thinking, okay, great. What I want to do ultimately is to make sure that the goods dispatched notes, all the goods dispatch notes at year end are on the system, even though, so because you see, technically it's until the purchase invoice goes into the system that we do the debit purchases and credit trade payables. But you think about it, when the goods arrive, they're sitting in the warehouse, goods dispatched to 050, for example, it might not yet be on the system because somehow there is no, it takes a while because there's goods dispatched and the supplier might send an invoice later. No, we want to make sure that ultimately that the goods dispatched, the goods received note is highlighted in the right period, if you like. So so what we then do is you can see what they're saying here is what you then do is you would then inspect invoices received after the year end to ensure that, if you like, you have the right goods relating to the right period. So of course, if it's relating to after the year end, no, I won't record it in my year, but I want to make sure that the invoices relating, maybe they've just been posted after the year end, don't relate to goods received in my year, if you see what I mean. So typically, although I know that many suppliers will send goods an invoice with the goods received note, and that's perfect, that's wonderful, because it all goes on in the same period. So what we're trying to do is, that's almost a cutoff test. We're trying to prevent goods from being recognized, from not being recognized in the right period. Okay, great. Yeah, and there's lots of other things you can always write on the side about asking managers for their processes and goods received. This is, oh, sorry. So this is what I was saying. How do you identify? You know, it's a kind of thing that I guess as you write more and more, you start picking up on. How do you identify goods that have been received but not invoiced? Because we must put them on the system, even though we haven't received the invoice. Do we not recognize them? So hopefully, if you get into the mode of it, you start understanding. Right. Okay. And this is what I was saying. Select a sample of goods received note immediately before year and follow through, because you want to make sure that that's when you receive the goods, and therefore that's when you should really recognize purchases. Then this talks about these payable circularizations when you're sending out letters to people to confirm balances. So really, really, important chasing up. Although again, if I have your supplier statement, I'm not too bothered. I can confirm it that way. It's all third party, really, isn't it? Okay, great. Now the other thing that we noticed, and I'm sure if you remember when you were doing your exams, probably I would argue more real, when I say look at there, I was about to say real practical accountants as opposed to our university students. I know James, and I don't know about Hannah. If Hannah, you can open your mic, Hannah. Have you come through an AAT route, or have you come through a university route?
No, I went to university with James.
Oh, all right. Oh, no wonder. Because you do know. Oh, yeah, that's interesting. That's Chichester, yeah? I know James went to Chichester. Oh, cool.
Yeah.
That's cool. Oh, that's good. So what I mean is that typically, I don't know if university questions would show you. I know A-level questions and definitely AT questions always present debit balances in. So you see that debit balance when you look at a supplier ledger. University questions, I don't know if allow for these little things to really force real accounting, because you have to then, because if you've gone through the AT route, or if you're in practice, you understand that a payment on account has caused this. This is something university students look at you with their eyes like, what are you talking about? Because if you're dealing with payment on accounts and you're dealing with actual systems, you understand why you can have a debit balance easily, and when you have problems with discounts, so they really get it. So it's important to always look for these debit balances, because they affect, of course, the overall balance, but it doesn't mean, you see what I mean, you need to adjust the debit balance to get the actual amount. I mean, these are things you should pick up on the reconciliation of sales ledger to sales ledger control account. Okay, great. So yeah, again, look, then there's the whole analysis, trade payable days and comparing to prior years, and then you're able to pick up on any differences, any other issues. Okay, great. So accruals. So when we talk about accruals now, we're technically talking about non-payable, non-trading type things. So overheads in effect, and other typical things that I would imagine, like interest. And again, like all things, what you always want to start your question with is actually get the list. Where are you going to get that list from? Get the list from the client, and add the thing, add the list, or cast it, fancy term, but add through the list to check for accuracy. And then and then you'll see that hopefully you can start to see that, okay, the best way to really test for accruals without even thinking about it too much. I mean, there are many things you start picking up on, but definitely look at the post-year invoices. You're thinking, okay, the invoice has now arrived post-year. I mean, you arrive post-year anyway. you can see the actual. So what you want to do is you can argue calculate for the accruals for reasonableness. There's many ways to do this. Typically, you might have had payments quarterly, so it sort of makes sense that if there are now 3 entries, the 4th would be similar to an earlier one. You write that, there's no problem. You're talking about trying to ensure that things are reasonable. Yeah. Now, there's the other accruals that we talk about. I mean, I highlight this question of loan interest. So you can calculate, actually carry out a proof in total. This is where you actually carry out a calculation. So if it should be 5% of the loan, calculate it yourself and compare it. So compare it to what it should be. Compare it to what it should be, compare it to what they've put in. Sorry, forgive me, on their in their ledger. So this is what I'm saying, post year end. And then you will never, I mean, again, like I say, do not ever think you are writing and compare year end accruals to previous year is as golden an answer as anything. Again, of course, what you don't want to be doing, what you want to give the examiner, what you want to show the examiner is that you're a practitioner. So you're saying compare, and spreadsheets do this. Compare the breakdown of one year with the breakdown of the next, and just in another column look at the percentage differences. You can be as literal as that, and then investigate each of them to understand, has there been any omission, is everything complete, because that's where we're going here, with completeness, if you like, in our accruals. Because also this list also highlights any new accruals that have come through. The organization is going to have new accruals, new expenses that have come through in that period. Okay, great. This is an exciting topic. When I say exciting topic, it is open to, you can really go places with it. Now, again, we don't need, I taught James, at least I can speak for James. I'm sure I taught this to James at A-levels. They definitely do it at A-levels. You definitely do it at AAT. You definitely do it at university. This question of provisions, what you might not know is what I'll talk about next, but the idea of a provision. So yes, we have financial reporting standards on it, which is why I'm saying I don't think students need to study financial reporting to get this, because you've done it already in principle, because you went through the principle of accruals. And prudence, then therefore leading to accruals. So the concept of prudence says that we must anticipate losses. That's just the basic principle, and not anticipate gains. So if there is a probability, and therefore in accounting, when we say a probability, we mean greater than 50% in effect. If there is a probability that we will suffer an expense, it is prudent to recognize the expense. And the question here is, this just allows you to now just get your marks, because the question is, well, I need to validate that probability, and therefore I need some authority, so probably some legal, maybe due out of regularity. So for example, maybe I'm sure this is the only example I use. I'm sure I've used it before in the class. So let's just go with, no, the problem is people, because I can't see your faces, I really don't know how you take this, but let's just go. So let's just say, when I say break their necks, it's not in a bad way. So say, for example, you're celebrating your grades. So we have Hannah and James who are wanting to celebrate their grades, and this is Graham's restaurant, and Graham is the he's put a big sign. He says, listen, there's water on the, he's not put a sign, that's it, he's not put a sign, and there's water on the floor and there's wine on the floor, and Dudley's the waiter, and Dudley says, please come this way, and then they come this way, and James and Hannah are so excited, and then James and Natalie is wearing these high-heeled shoes. I saw a pair the other day, Christian Louboutin, something Louboutin, one of the, I never know if I'm saying it correctly, and she slips, she falls, and sorry for the way she's a celebrity, and she breaks her neck. And I can say that because I haven't seen Hannah before, so sorry. So she breaks her neck. Now, a number of things could happen. And they go, and Natalie's the lawyer, and Natalie says, listen, we're going to sue. We're going to sue. And don't worry, I've been doing this for many years. Celebrities always make a lot of money, and I just don't like Graham. There you go. Now, because there is evidence that celebrities sue, it's going to be in the newspaper. Hannah is upset, and Natalie is a major player in the industry. It is prudent of Graham to recognize, because he knows it's coming, an expense, if you like, in his so that's kind of the level we're going for now. I mean, we see the elements anyway, of course, in bad debt provisions and things like that. And warranty provisions and whatever it is, but that's kind of this and what he must also do, is that Graham must also disclose. So you can see here how this begins to link to audits. So you're saying that I want to see evidence of that disclosure in your financial statements and the notes. I want to see evidence of the provision, the journal, if you like. I want to see the fact that a lawyer has said to you that this is the chance that you're going to get sued, if you like. I want to see this in the notes, in the board minutes of meeting, that this has been discussed, and that the figure is reasonable, if you like. So those are the things we're looking for as auditors with provisions. But it's all about probability. I mean, Graham's lawyers could just say to him, let's go for Dudley being the lawyer. Dudley could say to him, listen, don't worry about it. I'm a lawyer as well. I've beaten Natalie several times. This is not probable. This is possible. So if it is possible, it isn't more than 50%. He says, listen, I think it's a 10% chance she's going to win. Was there a sign there? Graham's like, I don't remember. And Dudley might just be like, you know what? Yeah, we're just going to say there was a sign there. Or let's put it this way. If there was a sign there, then Hannah might still try to sue, but Dudley thinks they have a chance. Now, if you're just going to believe that there's a possibility, it's not probable, we do not recognize it as a journal. We just disclose. We just make a note of it. And that is referred to as a contingent liability. So it's a contingent on there being more evidence, or there being a case, and that sort of thing. And really, that's it. So the standard does a lot, and does a lot of celebration of this thing, but that's literally it. Is it probable or is it possible? So if it's possible, we must still see the disclosure. That's what we're saying. If it's probable, we must see a journal, and it must be a reasonable amount. So you can see that in itself, that's what we're looking for. So the word inspection comes along, inquiring, speaking to the lawyers. You use your own language, but you're communicating with the lawyers to see if there's any further news on what's going on. If you like, what is the probability? Obtain the breakdown and add and agree. So of course, because the good thing I think about those kind of balances that are not common is that, like, even if you're trying to get a breakdown of expenses, whether or not we should capitalize or not, well, again, obtain it, breakdown, analyze each, add the thing together, because there's no really point in comparing one provision to another, one year to the next. I mean, you can, but these are unique events taking place. Like what I said, you just write freely. The lawyer, chance of payment, typically, has anything been paid yet? Obtain written representation from management that the provision is valid or appropriate. So use your own language. Don't worry too much. Just make sure that the points are being, there. I think that's a big point. Okay, right. So very quickly, this idea of accounting estimates. I mean, again, which is why we have standards on it. We have when we come to financial reporting, IAS 8 looks at accounting estimates, things like that. But the principles are the same. These are all matters of judgment. All of them, aren't they? And we see that. And so we want to be prudent about, we are expecting our directors to be prudent about these estimates. So really, again, we see the estimates come out. You don't need a standard per se, but we know that prudence applies. Let's go on. Let's start off with inventory. You don't need a standard to remind us that inventory is always recognized at the lower of cost and net. Sorry, I'm just checking if my window is open. I think I shut it. Oh, I did, yeah, sorry. At the lower of cost and net realizable value. So these are judgment matters. So because it's a matter of judgment, straight away you're thinking in terms of your work as an auditor, you want to look at the reasonableness. You want to inquire of directors. Again, because we're going to look at a number of estimates. Estimates appear so many places. So and it's an industry. So the question is, you want to be speaking nice to the director and asking, well, can I just see the paperwork and how you guys have come to this reasonableness, and how you've come to this understanding. And that's the audit work, actually. And then you want to test it. When I say test it, you want to then test for the accuracy and recalculate it yourself. As long as, and have they brought in an expert, to value this thing? You want to ask for that evidence. It's looking for that type of backing again. So here we are. So let's look at some of them. Inventory valuation. This isn't too bad because all I have to do, I've always liked this one. All you have to do is just look post year end. So you can say what you like. If I see post year end that you actually sold it for less than what's recognized as what's recognized as the cost prior to the year end, then we're writing it down, because inventory must always be recognized at the lower of cost and net realizable value. It doesn't matter whether or not, again, I think I highlighted last week, it is rare that there must be an economic shock, maybe similar to Corona, where you've bought some stock at 31st of December, and we didn't know Corona was going to happen. It happened in the first week, and suddenly all your stock will be sold for less. So in that case, you couldn't have known that you would have sold it for less than what you bought it for. But under normal circumstances, you start getting evidence of this fall in the market, a fall in demand prior to, and you probably bought the stock from a while. So the fact that the stock is selling for less than what you paid for it is evidence. We don't need any external further evidence. So we will write down your stock, even though you didn't. We will write it down. That's enough evidence. I mean, there's other things we can look at. We talked about when we talked about inventory. So depreciation method and useful life. Again, you have to trust the directors. But then again, like I say, we do have external, depending on what we're dealing with. Cars, I have external sources. And if I go out externally and I look at the value of that reg, I can look to see how reasonable your figure is. What's the difference between what you're calling it to be and what the external valuers, Auto Trader and co, are saying. It's not about being exact, it's about how far away is it? Is it reasonable within the bigger context? What's materiality? Again, that's a matter of judgment. You might think the car is worth 16,000. Auto Traders were saying it's worth 15,500. Like, it's okay. 15,500 over another 5 years or 10 years is nothing. £500 difference is fine. You're happy with that, as opposed to saying 14,000 to 16,000, and then you can argue a little, and then so you can see it's all a matter of judgment. There is no right or wrong per se all the time. Okay, great. So we have provisions. I talked about contingent liabilities, right? This is, again, so with this, what you're testing for is the disclosure. Disclosure. Has it been disclosed? You want to see this case that someone went into this restaurant, fell and broke their necks. Irrecoverable debt, and of course, we know that we see we studied how we arrive at a provision for doubtful debts. Based on the experience of previous years. So what you want is them to show you, and you can actually write this out. You're saying, well, we want to understand. I would look at debts, if you like, that are over a 60-day period, if you like, and then or 90-day period that have not been paid in the last 90 days, and look post year end. Be that literal to see if the money has been received, and then inquire of directors to see if there's any paperwork with regards to the paying of these debts, or directly circularize or communicate with the customers to find out if there are any issues, and check in the news and the press. Are they struggling? What is the probability of this money coming in? And then we now have to write it off, or that sort of thing. Okay, great. And then, of course, the other thing, of course, the big one, of course, is this a business of revaluations, estimates here, right? Estimates. We have estimates there, and there is the question, of course, of whether or not specialists have been brought in. How has this been done? So you just want to see the paperwork. That's what you're really asking, and as long as you can write that, then you're there. Right, so again, like I say here, and you can see how these figures, these estimates can affect the balance sheet. I mean, once you can either underestimate liability because you don't want it to hit your expense and payables or accruals, right? Or you can overestimate an asset in cases of revaluation, if you like. Or again, I'm sure you're thinking about what you can see where I'm going here with inventory if you don't do that. So it is a big point. It is a big area that enable manipulation. And remember that when we discuss fraud, fraud wasn't just about the misappropriation of assets. No, fraud was also about the manipulation of financial accounts, financial statements. So the fact that directors are manipulating financial statements is also fraud. So we want to have this air of professional skepticism, and these are valid audit risks. So it's an audit risk. Every time you see anything like, oh, year-end covenants are coming up, or year-end bonuses are coming up, and straight away professional skepticism, potential for manipulation. Yeah. So great. Again, so just a few ideas here. You want to just understand, you can see it's just trying to understand how management identifies those transactions, how management actually makes the estimates, and what control procedures they have in place. And yeah, and it's just us really analyzing the degree of uncertainty with whatever the accounting estimates are. Yeah, again, typically events after the reporting period will provide some evidence about the estimations that have been made at the year end. So estimates on provisions and what I'm saying will always give us a good clue. Yes, again, like I say here, developing an independent estimate to use as a point, consider whether specialist knowledge is required, maybe a lawyer, and what are the effective controls. So I mean, obviously what we're really saying here is that how regularly do they evaluate their policies in general? I mean, there's a host of them. You evaluate your policies on your depreciation, for example. I mean, these are not set in stone. An organization should be constantly, regularly evaluating their depreciation estimates, depending on how often they're using the assets. Or even the revaluation of their buildings with, yes, financial reporting, there's some knowledge there, but the general principle is that if you remember, you might remember, but the concept actually is, it's not a standard per se. I mean, a standard verifies it, but we have this within the cost concept in accounting, the historical cost concept. So if you remember, the historical cost concept says that when we buy an asset, we should recognize it at cost and leave it like that, if you like. And that really was the original concept. And then you depreciate the asset over its life. But what that also allowed you to do was that if you now chose not to recognize that historical cost and you chose to revalue, then you needed to continue revaluing. So you needed to choose one of the accounting policies, you might remember, historical cost versus revaluation. So either you keep, so typically we expect you to keep a factory in the middle of nowhere at cost. But it was very much this question of relevance versus reliability, if you like. So if you have a really, it's the balance. This question of, and it's still a debate. There's no right or wrong way, but there's just the debate about reliability and relevance. So the historical cost is reliable. Revaluation is not as reliable. But if we just naturally, because you're not selling the thing, but yet you're revaluing it based on what the market demand is. But if we can find other buildings and other assets in the area that are being revalued regularly, that's fine. But it does make sense because it means the state of financial statements are a bit more relevant because you're showing in real-time values the assets, especially when you're dealing with, say, financial instruments, certain service sectors. Their balance sheets need to be current for people to make decisions. So you can see the conflict there. So that's how you would discuss it. Okay, great stuff. Excuse me. Yeah, now there are some balances in a good way which are fair. When I say fair, when you're thinking about them, you don't even need to think too hard because there's no question of I won't have time. No, you will have time. There's only one equity section. They're all material by nature. just by nature, the sensitivity of share capital, reserves, and directors' remuneration. So you're almost wanting to recalculate. And I mean, to be fair, not many organizations are raising new capital every year. Most organizations will have the same capital equity structure for a long time. But if they do, you want to verify. You basically want to kind of examine and inquire the new sources of capital, and kind of see a completion or list, if you like, of the new share capital register, and then add it through for, if you like, accuracy, if you like. So that's all we're really doing. To make sure. And then, I mean, it's silly things like, I mean, when I say silly things, you might just take for granted the clear separation of share capital from share premium, the clear classification of the two. Cool, great. So so really what we're really doing is we're just agreeing, we're just agreeing it just to make sure that there's no fraud or anything unusual. So we're agreeing the share capital to the agreements or the documents. That's all. We're inspecting the board minutes, if you like. So generally, I mean, again, like I say, this is not something that's normal. Then something must have happened. You don't just issue share capital, because remember that issuing share capital means you have new shareholders coming into the organization. You would imagine they would have discussed this at board level. So you just want to verify the issue, and you want to verify the journaling that it's correct, and you want to yes, ensure disclosure of all unpaid share capital. So again, if you like, we literally will have here debit, if you like, unpaid share capital, credit share capital. So it's possible that people are still willing to pay, are yet to pay, but they have been given, if you like, share capital in the organization. Dividends as well, of course, are all material by nature. So typically, we want to typically take a sample of, well, when I say take a sample of the final dividend, but typically we should be able to see the instruction to pay out a dividend, so that it's not fraudulent. We're very clear that the board did agree and the total amount they would give, if you like, and then, if you like, inspect bank statements to agree dividends paid. And yeah, you can inspect dividend warrants to agree dividend payments, but typically that's the process. I mean, because there's so much of it, you won't remember absolutely everything, but in your mind, if you're thinking of the processes involved and what you would want to make sure was in place, so to speak, that the event had actually occurred, that's what you would do. And no better place than the bank statement, because money going out, if you like, is showing that dividend has been paid, and reconciling that, if you like, to what was declared or what was agreed to be paid, if you like, on the board minutes, because this is a board event. Another one, this is the directors' emoluments and bonuses. So I think we even have a question. Hopefully we'll get to do the question on that. Typically we always, this is just because these are very sensitive matters, but this is not for the eyes of everyone in the organization. No, it's just very confidential. But as auditors, we have access to that confidentiality, because again, as you can imagine, directors' bonuses are linked to performance. So there's a lot of interest in how much directors are paid and whether or not they have been fairly remunerated. And so typically we do carry out this. It's material. All directors, it's material. Because a number of reasons. Sometimes, I mean, this is quite gentle. Sometimes we have non-executive directors. I mean, the reason why we have this problem is because, I mean, I've seen it before. You have, it's not a problem. You have some of the bigger private limited companies where you have directors and their wives. So their wives are directors, but their wives don't do anything in the organization. So they might be non-executive directors, and it's almost for tax purposes. So typically, they might be paying directors out in dividends, and or no one might know this. You see, it's about disclosure. It's about disclosure. It's not that anyone's against it. We just want to see the disclosure. So typically we want to see a disclosure of all the directors and how much, if you like, they have been paid. So in the future, shareholders should know who the directors are and how much they've been paid. So even if Mrs. Jones is sitting at home just having fun and watching Netflix, and she's receiving 50 grand every year, that's fine. You know, let's just know that. So it's important we get a list and get all the benefits, everything. We want to see the full list, and we want to split it. Again, you will see that what you'll see, like a little spreadsheet of directors, their names, normal wages, bonuses, benefits, everything, fully disclosed. That's what it is. And then, of course, we now inspect payroll, kind of link this to payroll records and agree wages and these sort of things to that. Yeah, I mean, typically I haven't seen this type of fraud. I think typically it does naturally work, just because some directors might declare, you might see something less. So you'll see them having that, and then you have a different payment, different amounts have been paid. The other reason why this is important is because directors also have kind of the power to take out money, almost like a director's loan account. Of course, that's the biggest one, right? The director's loan account, without paying interest. I mean, there is a tax on it if it's not paid in time, and there's a benefit there, isn't there? And we studied it in tax, where people up to 10 grand, it's almost irrelevant. That 10 grand seems like not a lot, but that is a lot of money. The fact that a director can take 10 grand without any questions asked. It's only when it goes over 10 grand we start asking the question of additional interest or a tax purpose. So any loans the directors have taken out should be disclosed. And you would understand why directors wouldn't want anyone to know they'd borrowed any money from the organization. I remember I saw a number where directors actually used company funding or company money to pay for fees for their kids, private schools, or whatever it is. So it's no problem. It just needs to be disclosed. So they were very aware. And then they pay it back, of course, but there's a tax. If I recall, for lack of memory, it's called Section 419 tax if the directors hadn't paid it within 9 months of borrowing it from the organization. Okay, great. Again, this is what I mean. We're just trying to, inspect board minutes for discussion, approval, inspect bank statements to verify amounts, obtain written representations. So written representations to directors is the weakest form of evidence. Directors saying, listen, yes, this is true, we did this, and we sign off on that. Great. And then reserves, we're just kind of doing what we would ordinarily do. Typically, you would do this at the beginning of any audit. You would check your opening reserves, your opening share capital to last year's closing reserves, if you like, just because of systems and, when we move from one year to the next. And if you have any movement in reserves, if you come across those, I don't think you'll see many of those. Oh, great! And then payroll. I think this might be the last topic. Let me just see what time it is, because my time is on my. Okay, great. Oh yes, payroll might be the last thing. Payroll is an interesting one. It is popular. When I say popular, it's easy to examine because it's interesting. When I say it's interesting, there are lots of elements to it. Right now, I think what you always want to do, and I think we might already have seen a question on it, that there is a clear difference between payroll and HR. If some organizations make it look seamless and make it look as though, and sometimes they sit close to each other, and of course they are connected, but there is a very clear difference between the people who bring on staff and interview them and keep their records and identify who they are and and structure their contracts and how much they will be paid. And so there's a HR director who's involved in all of that and is responsible for the human resource need, right, of the organization, and pulling them in. So and let me complete that cycle with leavers. So HR is also responsible for ensuring that when people leave, they are no longer their contracts have now kind of come to an end. They do put the paperwork clearly, if you like, and they have to communicate this information to the folks that process payroll. You see, because right, then they now put them on the right tax codes. So you can see why it has to be different, because the payroll folks are looking at tax, holiday, dealing with all that paperwork to do with everything, all of that, and also if someone hasn't worked, they get fed the information, if you like, and then they either process the hours, and then when someone leaves, they ensure that they get fed this information from HR, and then they stop the person from getting paid, because they basically enable the payment to the person's bank account. So if there's a change in your bank account, that gets updated on HR, and that gets fed through to payroll. So everyone's talking to each other. So very much connected. So generally, you want to be very aware of that. So typically with payroll, what we're doing is that there are a number of things here that we want to do. The other good thing about this is there's a payroll control account, so that's fine. So we are also responsible. So let me also say another thing. We're not just interested in just the pay of the individuals. We're also interested that the right national insurances have been paid by the organization to HMRC. That is part of our audit, because if we don't do it on time, there are fines, if you like, and there are issues there. So we're not just auditing whether or not these people have received their net wages. We're also checking to see that the HMRC payments have been made on time. That's the first thing. Now, the other good thing about payroll, which I think is good, is that if you're thinking from an audit point of view, is that we want to make sure that it is complete. Now, what does that mean? We want to make sure that people who shouldn't be paid are not paid. That's the other thing. And then, so typically what we also want to do is look for accuracy. Now, this used to be quite normal, quite common, this recalculating the gross and net pay for a sample of employees. I mean, a lot of this happens on software now. So what you can still do is you're almost trying to test the accuracy of the system. That doesn't work. So you're almost, again, looking for a sample of employees, picking their payroll, pay slips, and checking it to the final payment on the payroll listing, just verifying it to that and paying and relating it to the bank, depending on how it goes out through the bank. But you're just doing that for accuracy. So the first one is we get our list, if you like, and we literally get our list based on the payroll system from our ledgers or whatever it is, and tie that to the set of financial statements. So you probably will be doing this through a wages control account, because then that will have all the entries ultimately. But that's what we're trying to ultimately do. Again, like I said earlier on, it's through a sample. You might take a sample it's really for accuracy, just to ensure that you have the correct deductions, that the system is doing it. I mean, it's rare for the systems to be wrong, but that's fine. So this is what I was talking about, a sample of joiners and leavers. So really what you want to do is, at the end of the year, you just want to make sure, so you would take a sample of people who have joined the organization at the end of the year and people who have left the organization at the end of the year. And all you're doing is to check that people who have joined the organization at the end of the year have been paid in that year, and people who have left the organization at the end of the year, if you like, typically have not been paid. That's kind of the test there. To be fair, you could carry out this test throughout the year, but typically at the end of the year is a bit more critical. Then you can go into sort of the idea of do these people actually exist? Should they? And that's another good one. So you're looking for existence. I'm sure I've told you my story of John Doe, but just because of time, I won't tell you where I'd gone along. And just because his name was John Doe, I just didn't believe someone could be called John Doe. And I'd gone in and asked for John Doe, and he looked at me and laughed. Everyone laughed and said, "Don't worry, people have been doing this to him for the last 10 years. You're not the first." And it was a new job we were doing. Okay, great stuff. So I'll carry on just before I hit the break. So what are we talking about here? This is now, we're now into the income statement zone, and probably the big one we're always going to see is revenue. Trying to verify revenue. Revenue is a flow. Revenue is a flow. I want to assess, if you like, whether or not revenue occurred, if you like. So I'm looking to see if it occurred. I'm also really trying to test completeness. Is all revenue there for that period? Have you put in the right, when I say put in the right amount of revenue, is there revenue that shouldn't be there that's there? Because typically people are always trying to overstate revenue. That's the other thing that I want there. Then of course we have the issue of, it's a subtle one, but it's highly important. So what I want you to do, I don't know if my slides, hopefully my slides will mention it, but whenever you think of revenue, I need you to think about sales returns. Same with purchases. You cannot think about, you can almost write it on your slides, you cannot test revenue without testing sales credit notes. Because, and let me make this very clear here. If you sell goods in December, in say December, in the month of December, and you sell £1 million worth of goods, and post year end, we have credit notes relating to the sales in December. So if you now have in the month of January of the next year, credit notes worth 500,000, right? There's a term for this. I'm exaggerating, and that's referred to as window dressing, where we suspect you've actually done something here. But let's just say it's a normal scenario. You have credit notes of 200,000 or even 100,000. Here's the thing. Those credit notes of 100,000 need to be adjusted in your revenue of December, right? So really your revenue is not 1 million. Your revenue is 1 million less 100,000. So just because it's after the year end, no, they relate to the revenue of your year. So that's referred to as an adjusting event. It connects to your year. It doesn't sit in the next year. We don't say, oh, we'll do it next year. No. We have evidence here that these goods were returned. So your revenue really and truly is not 1 million. It's 1 million less than 100,000. So if you can see the number of issues I'm trying to do to verify that the revenue at the year end is what it is, I'm trying to make sure, I haven't even come yet to talk about whatever bad debts and all that. No. We'll deal with that through debts, through trade receivables. But in terms of just revenue, I just want to first of all test, do these things occur? And then I want to make sure we have revenue as it should be in the right period, in terms of just the invoices. Then I want to test the credit notes. So you can see you have a number of things to gain marks on the credit notes to make sure they're the right period. So typically we will, at the year end, we will always look at credit notes post year end to make sure that they only relate to, that none of them, or technically the credit notes after the year end relate to sales after the year end. If we have credit notes after the year end that relate to sales in our year, we need to adjust revenue in our year. I highlighted earlier on that the big point of when a sale actually occurs is the goods dispatch note. The goods dispatch note, that's the big one, the goods dispatch note. That's the key. So let's go through this. So this is the first thing. So inspect a sample of goods dispatch notes before and after the year end. This is critical. Because, like I said earlier on, the goods dispatch note, dispatching a good is evidence of a sale. Now, goods dispatch notes before the year end, of course, are sales, therefore, I can now certify that, yes, these are sales that were made before the year end. And goods dispatch notes after the year end are sales that were recorded, if you like, and are sales to do with in that year. I don't want to see because you see, so that you can see where the fraud is that you can dispatch goods. You have your goods being dispatched on the what's the word? It's a fraud, but just to see where I'm going. Dispatched on the 1st of January, 2nd of January, 3rd of January. This is when they're dispatched. But you could have created a sales invoice for the 31st of December. So in effect, you are recognizing, if you like, an invoice too early. And I don't want you to do that. I want you to recognize revenue in the correct period. So I don't care whether or not the sales invoice here is showing 31st of December, the goods were dispatched on the 1st. And therefore this sales invoice should be recognized in the following year. So I think the more and more you're clear as to what we're trying to prevent, then you testing it, you need to get your head, you'll be happier with saying, I know what I'm looking for. Thank you very much. Right. And all I'm doing is then I can verify it to the management systems, or the management accounting systems, to the sales daybook in effect. And because the sales daybook the dates will therefore, right, feed through to whether or not we will arrive at the 31st of December. Right. So although again, like I say, many systems do link goods dispatch notes very neatly and nicely to the sales invoice, because typically they will dispatch the goods first and then you'll send out the sales invoice. Okay, great. That's the first thing. So, and I'm testing cutoff. So again, this is probably one of the biggest tests with revenue that you want to write straight away with revenue. I want to inspect a sample of goods dispatch notes before the year end to make sure that they only represent sales happening before the year end. And you can tell the examiner why, so he can see what you're doing and know after the year end. So cutoff, probably your biggest revenue test. Then, of course, there's this question of accuracy and and of course, what you want to do is you want to an occurrence. So I've talked about. I might not have talked about occurrence. So occurrence, what I want to do is I want to pick. I want to pick two. Sorry, let me just do this. I'll maybe pick 2 a month, and literally start off with sales order and walk through all the way to receipt of cash. Literally walk through, go sales order, goods dispatch, sales order, goods dispatch note, sales invoice, money in the bank. Literally just write out 12, just to be sure they did occur. Then, of course, for accuracy, I'm just picking a few and just recalculating discounts. And although a lot of this happens online, so it is likely that they are correct, but I'm testing for accuracy as well. So this is what I was saying here. What I said, this is really occurrence. Select a sample of customer orders, agree those to the dispatch notes and the sales invoice to the inclusion in the daybook, and include that, and then test that to the bank statement for receipt of cash. Then you're sure these things actually occurred. This is what I was saying. So inspect credit notes issued after the year end, trace to the goods dispatched, and ensure the sale has been reversed. Right? Cool. Right, great stuff. And then once you've done those kind of more hardcore physical substantive tests, then you have your analyticals, which is what I was saying earlier on. So this is when you're kind of now in the office or even on ground, where you're actually breaking up what is revenue composed of, and I'm looking for fluctuations. These are just as good answers as any. I mentioned, I started the class off by talking about this. So I'm comparing actual revenue breakups. So maybe they sell different lines, and I want to compare one year to the next, and I'm doing that. So you can go whatever way, probably revenue against prior year, investigate any fluctuations. It just gives you, it pushes you into asking other questions that you might not pick up straight away, if you like. Compare with budget or forecast, look at GP margins, investigate any significant differences, because that will make you think again about other things. And if you saw what I just did with revenue, I'm applying really the same principles to purchases. the same principles of occurrence, the same principles of accuracy, the same principles of cutoff. So those assertions of occurrence, accuracy, cutoff, literally work, if you like, the same way. No real same idea. So you can see what they're saying here. Inspect goods received notes before and after the year end, if you like, to ensure they're in the correct period, if you like, right? Because as soon as you receive the goods, they're in that period. So you don't want, it's basically the key point here is anything I've received after the year end, even though I haven't received an invoice, I don't want to be recording it in my year. I want to literally wait or record it in the year after, in the period post my year end. Okay, great. Here we are. So again, you can see for accuracy, I recalculate some discounts and sales taxes. Again, like I said, completeness, I am literally just trying to see if they occur and everything has been put in there for completeness. A sample of purchase orders, and agree these to the through to the inclusion in the yeah. So to inclusion, I want to make sure they're all in there. Everything has been put in. And then there's the other one here, inspect purchase invoices for a sample, name of the client. So a number of things, accuracy, occurrence, and classification. Yeah, those there. Again, analyzing between one type and another is always GP margins, significant fluctuations. Cool, great stuff. Right, brilliant. Now, in the textbook, there is a bit on looking at, if you like, public sector audits, so to speak, because they don't do, and charities, they don't really do, they're not profit driven. So we will come back to that because a lot of the questions that we focus on and we see are very much on profit based. So we'll sort of come back to that. But so what I want us to do is kind of spend, because that could take up time as well. But really, we're more likely to see profit type, but we will come back and do it and hopefully see a question or two on it. So yeah, let's see, what time is it? Let me see if you can, yeah, I think a break. Yeah, break is in order. So let's come back at 5 minutes. What is it? Yeah, oh, so you know what? Hey, it's audit, it's okay. Come back at 11, you can have 18 minutes. Come back at 11 o'clock and then we will jump into a question. Yeah, cool, great stuff. Okay, right. So let's go to the first question we're going to look at, which I think is a good question to start with. Kicks off. Let me just yes, here we are. Sorry, let me just. Sorry, I'm just sharing my screen. New share. Right. Okay. Okay. Sorry. Let me just shut me out. Yes, I'm just taking you to the question. Okay, great. So it was the first one, Darjeeling. Sorry. That is question 15. Oh, second. 151. Sorry, the window is shut. Sometimes, sorry, the noise. Forgive me. 151. So what I want us to do is, now we have done this question before. You might have, if you had to go at it, but we only stopped. We did this question and we stopped at we did A, B, and we did the audit risks. But the reason I start off with this question is because now by going back over it, you're revising, of course, and then part D and E is looking at describe substantive tests. So you can see that this is a full question, if you like, where you have audit tests, and then as a result, you now have substantive procedures that they would expect you to think about. And what I really want you to do is to, I'll explain. My focus, of course, really is just on D and E, although I want you to, I'm going to read through. I want you to, I don't want you to write out your answers for C, of course not, but I want you to just underline them as I talk through them. But I want you to focus on D and E. And what I want you to write is, I want you to write them in your own words. I don't really want you to, don't feel you just write them as to what you would do, and then I can then help you tie those answers to maybe the mark scheme or make them a bit more refined with regards to the examiner's comments. So because you probably, when I say probably, greater than 50% pass on just your understanding of the problem, which is why I said that the questions are very much specific to the problem. So they're not, you're never going to get a question that just asks you just in general. They just want you to really, although the answers in the back of the book might look like they're in general, but you want to just really speak in the language of the question. You want to answer the question. And just think, if it was your business, how would you deal with these faulty paint products, if you like, which is what we're starting off with. So what I want us to do is that, and you don't need to really calculate the ratios actually either. You might have this question from before somewhere in terms of the first few bits, but it's good to read through it again. Just highlight the risks as we go through, because I'll go through them as I talk through, because it's good revision. And then, but what I'm more interested in is you writing, and you can see here it says there's 3 marks. So in your mind, you're thinking you need three. So it says describe. So what you want to do is, if you like, you want to just almost have a bit of a blurb on it, not just and state what you would do, describe what you would do. Again, don't worry, we'll see when we compare to the answers, but don't feel like there's a set list of standards out there. As you can see, it depends on the question. Okay, great. So describe that, and then I'll give you some ideas as I'm talking, and then also do E as well, right? Is that okay? Are you happy with? Yeah, cool, great. So read through, just kind of highlight for yourselves, kind of point C some of the problems, but try and figure out where they're going with the faulty paint. So I'll give us about, I think I'll give us about 15 minutes for this just bullet points, really. Yeah, bullet points. So technically ignore A, B. Yeah, ignore A and B, and just jump into, as you're reading, you'll pick up on C, but highlight them for your own revision, C particularly, just to see for yourself if you would think about those as risks, and then we can. Yeah, so 15 minutes and then well. James, I think this might be, do you have the relevant question on the PDF? It won't be 151 for you, but if you look.
It's okay, I've already found it.
Oh, perfect. Perfect.
Thank you.
No problem. So about 3-4 minutes, and then we'll jump into it. I guess I can't really gauge. It's difficult to gauge whether you're finished or not, but we'll kick off in 3-4 minutes, and then you can throw in any other answers you're thinking of as we. Okay, right. So from the so I mean, I'll get you talking in a second. I just want to go through just highlight a few things. Now, what you will notice is that typically once you have answered one question on revenue, you want to keep your notes because the same questions keep popping up with a few adjustments. And once you are comfortable with the standard answers, you know, and what I'm trying my best not to do is just to say, oh, to get you to cram answers. So just if you're thinking about what it is you're looking for, did it happen? And even if you, in your own words, you write how you would work out, did it happen? Is everything in there in terms of complete? When I say complete, did every order that it came through, did it get through the system? Was it actually put onto the system? Are there any paper orders still sitting around that haven't been processed? That sort of thing, that haven't come through to the final sales ledger in the end. And then accuracy, and then cut off. And I've told you, hopefully I've tried to really drill. When we think cut off, we're thinking goods dispatch notes for revenue, we're thinking goods received notes for purchases. So when you're thinking like this, to be fair, you now have a standard template, and then you're all right. And then I haven't even started talking about analysis. So really and truly, this is where we think people get away with audit, because once you obey those rules, once you keep that standard in place, you're there. And then you can build on your answers, because then you can then get arrogant. But you don't want to get arrogant without stating what you would ordinarily do. because then when I say get arrogant, you can then just start, writing anything you like, really, as long as you've written, because it will make sense anyway. Right, let's run through. So you've done this. Well, some of you might have looked at this before, and the I'm not going to. What I'm just going to do is just highlight the risks, and I hope you're picking them up, but we won't discuss the risks in detail. If you remember, and you'll see the risks over and over again are similar, and then audit becomes quite second nature to you, but you want to be doing at least 2 questions a week, right? Definitely when we finish our syllabus, all we'll be doing would be questions anyway. So we should be finished probably first week. I'm hoping to finish first week, second week in July. So we have at least 6 weeks for questions. Okay, great. So it says that these people have spent 0.9, which should be included in intangible assets on the development of new. As soon as you see that, development of new product lines, big red lights, risk here. Development intangible assets, we're going to be capitalizing this. There is a likelihood that there are things in here that should not be development. There are things in here that should be research, that should be going through the expenses, and therefore consequence, you're always highlighting that those big words, the overstatement of intangibles or assets, and therefore the understatement of expenses, blah 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 blah. So that's your final point, where you're trying to go. Technically, if you've been asked about this, you will never break away from the fact that you want to obtain a breakdown of these expenses, if you like, and then really see. We might have also talked about this last time, but I feel like I'm answering a different question. This is the problem with audit. But you then want to ask, if you like, and then how have they, because you remember with development, we want to be asking, well, development means this thing is now technically feasible. We have the funds to complete. Someone has actually said this can bring economic benefits to the company. So we want to see the evidence for that. Okay, great. That was the first risk. The next thing was this new manufacturing line, and they had put in all these, they tried to capitalize all these things at 2.2, 0.4, and these two were fine. The problem was this 5-year servicing. This is a 5-year thing. It should only be done for the year, so it should be 0.1 as opposed to 0.5. So we need to derecognize that, if you like, and only recognize 0.1 of that, and therefore, and there's nothing wrong. I think audit works well even with financial accounting. Show the examiner the journal that you would use to derecognize 0.4 million of that, if you like, and some sort of prepayment, if you like, that should be released every year, because it's maintenance, if you like. Okay, great. So that was the next risk. Then we had this business of the bank. I'm just going to open, because I want to hear this, so that it's an important point that we mustn't forget. This 4 million from the bank, what is the risk? What's the audit risk? It's not common. It is commonly asked, but people sometimes forget. I mean, anyone can speak. With the 4 million, what is the risk as far as the financial statements are concerned? Classification. I mean, so I'm highlighting this point. It's really important to always remember. They always ask it. It's a little one. It has full marks. There is the risk that the loan will not be classified in the current liability and non-current liability. Really important to always highlight this question of classification. Really important. That this is likely to be classified. So because again, like you can see the issues there, right? If you don't classify it correctly, and therefore next point, disclosures. The company, shareholders want to know. So disclosure and presentation stroke classification. How has this been classified? Has this been classified correctly? Then, of course, you have this problem here. They want professional skepticism. So I'm aware here that, so with a closer eye, so your response is always to be professionally aware that there's a likelihood for potential manipulation or exaggeration or overestimation or whatever it is, because they want to list. And also I'm really going to focus on those development costs. Now I'm really excited about those development costs to really see whether we should capitalize those or whether they're all research. Okay, the issues are here now. So they've done this thing. So this paragraph here is all about the revenue. So I guess we'll just do it. We'll deal with it here as well first. So we have this company where they have the revenue. They can do this, boost revenue, extend credit terms. Remember, the question is focusing on revenue, not particularly on trade receivables. So I want us to focus on revenue. This is the point, which is why I'm trying to clearly separate the two. I'm not testing trade receivables. I'm testing revenue. Important. So they're offering these credit terms to these customers. They increase their sales orders, even though we see that they are connected, of course. So these people made an announcement for price promise. It'll match this. Customers who are able to prove they could purchase the whatever, and the company intends to include a refund liability, which is based on the levels. Okay, great. So so let me hear from you. I mean, I'll write down. Let me hear from you what your in terms of, because the question then asks, describe, let's talk about revenue here, describe some substantive procedures to gain sufficient and appropriate evidence in relation to their revenue figure. Now, the good thing about this question, this is another point here where you can see, just to highlight all the marks, is the question isn't asking you, the question might ask you, the question might have asked, describe substantive procedures to verify their price promise. It might have just asked you to focus on the price promise, and then you would just have focused on it. But it's asking you for a number of things, including and also making you aware of this scenario. So just in your own thoughts, I mean, just, please, everyone speak at different points. I mean, I don't want to call your names, but or just tell me what your thoughts are. I'll call your names, that's fine. I'll go around the room. Why not? Let's have some fun. So I'll start off with Graham. Graham, give me one of your points from here. How did you, and it doesn't really matter, how would you have looked in your own terms? It might be from some of the slides we've just looked at. What was something you were thinking of looking at in sort of getting some evidence on revenue in general with this company? It could be to do with the price promise, doesn't really matter, just any of your points at all.
Sorry, is this part C?
No, D. Sorry, because I see the story on E. Yeah, this is no, not C. Sorry, this is E. Question E. Looking for procedures. It's just that I'm doing it in the space here. So I'm not looking at the risk now. I'm just looking at what procedures you would do regarding revenue in general. So have you done D and E, Graham? Sorry.
No, I'm just doing C.
Oh, you just did C. Sorry, I wanted you to do D and E.
Oh, I thought you said to do C.
Sorry. I said just highlight the points at C because we've done this question before. No problem. That's okay. No, that's okay. Let me just. Sorry. No. You're fine. You're fine. You probably will tell me in a second. Let me go to Dudley. Did you do D and E, Dudley, or was I unclear with my what I wanted? Sorry. Or did everyone just do C?
I've done D and E.
Okay, that's fine. Thank you. Just no problem. I just want one point from your what you thought we could do in terms of getting any substantive procedures for revenue.
I'll put some on the lines of the auditor will need to take the overall revenue figure and compare to previous year's levels and budget.
Perfect. Yep.
Anomalies.
Yeah. Exactly. So what I'm really trying to show you guys to understand is that it's not really as crazy as it looks. Dudley has gone for an analyze, and what I want to do is I want to structure it. I want to structure what you're doing. Now, and that's correct. Perfect. That is. So yes, sorry, Graham. I wanted you to look at D&E, but you're right. There was a risk. There are risks there in C. So even before we look at, and thank you, that is as valid an answer as possible. It is, and we'll see that answer that that Dudley's just given in the mark scheme as it is. I think it literally looks exactly like that, probably. But what I wanted to do for you was to structure it. Before we get to analysis, Dudley, you're right. Now I'm just really pushing your work. You've passed already with a mark, with question, is in terms of structuring it. you could have had one or two things come through first. Do you see where I'm going? I mean, it's just as right. There's no problem, but just in the order of how we would nicely lay it out for like a perfect mark scenario. So the first thing, so the first thing, I'll say the first thing. Maybe it's about obtaining. You know, I mentioned I've hinted at it, but now I'm talking about it because we're doing a question. You almost want to argue that, listen, I want to obtain a list. I want to actually obtain a list of all the sales ledger, or obtain a list of all the revenue items, and of course then reconcile that using a sales ledger control account, and confirming that to the I want to, if you like, to the financial statements, or obtaining revenue on the financial statements and reconciling that, if you like, to the list from the management accounting systems or the management information systems that have come through from the sales ledger. Or I want to carry out literally a sales ledger control account and look at that, the final year reconciliation, reconciling what is on the financial statements to what is on, if you like, the ledger. That. Right, good. So that's the first thing, and then he, Dudley also mentions analysis. How about occurrence? Let's go to James. What else did you write, James? What did you have here? What could you do?
So I spoke here about comparing the gross and the net profit margins.
Yeah.
Why they differ.
That's true. That's good. So that's another analysis thing you could do. Okay, great. Yeah. Yeah, Hannah, where did you go with this?
I spoke about taking a sample of invoices and recalculating the totals, including any discounts.
Exactly. Good. Exactly. All valid answers. So Hannah there is looking at accuracy of these figures. So these are all valid. So you see, what I'm trying to do is we must touch the spread of accuracy, of analysis. Good. So what about occurrence? Natalie, any where did you go with this?
Said about performing a walkthrough, so sampling a customer order, dispatch notes.
Smashing. Perfect. Now, this is the good thing about audit, right? Tests of revenue are not going to change. Doesn't matter what the question is. So we will see that it occurred. I will carry out a walkthrough. You've used the technical term there. So I'll carry out a walkthrough, literally take the order. So really what you want to do is obtain your list of revenue. Excuse me. Obtain your revenue list. Carry out your walkthrough. Did the thing happen? And push the examiner. Show the examiner you understand what's happening. I don't just want to do a walkthrough. A walkthrough, you want to carry out, you want to almost say, do a walkthrough of invoices, of orders for the whole year. So you want to pick, literally say, I want to know, because we want to know if they occurred, not just, you know, so your sampling has to show that you are going and looking at through the whole year, even orders at year end. And as Natalie said, I will carry out and look through all of these to see literally whatever, go through the entire, all the steps to when you actually receive the money, and then they occurred. Then kind of where Hannah was going, well, and then I will take another sample. I mean, you could use the same sample to actually look for accuracy. So I will then recalculate, right? A-E-I-O-U, the U, recalculate, reperform. I will recalculate whatever, she mentioned discounts, blah, 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 blah. And then there's one more kind of big one that's missing. Graham, I'll come back to you here. Yeah, everyone else has spoken. I highlighted it at the beginning, but it's the 2 words. The test.
Control test?
No. 2.
Cut off.
Tough. Hey, my charades, we could play online. Cut off. Graham, what is the cutoff test? I'm pushing you because it means that I'm pushing everyone, because it means that I'm trying to force you to remember how would you would carry out a cutoff test. Where would you? It's okay. It's good because I'm doing this. It's good. And don't worry, no one else will see you, so there's no shame. It's fine. We're all friends. Do you remember what am I looking for when I'm doing a cutoff test? It's important I ask because I want you to remember. That way you won't forget these tests again. Am I looking at?
What the relevant periods?
Yes, I'm looking at relevant periods, but what exactly am I? Because what am I physically looking at? What documents am I looking at?
Oh, the good dispatch.
Yes, good. I'm looking at the goods dispatched notes.
Oh, okay.
Yeah, perfect. No, perfect. You see, because again, that's the problem because I literally spoke for an hour, 10 minutes. So much data. Sorry. Okay. Oh no, sorry. No, that's okay. That's all right. So I'm looking at my goods dispatch notes, and as you said, and Graham, I want to make sure, right? You want to literally let the examiner know you really know what you're doing with those goods dispatch notes, right? So you're saying, I'm taking a sample of goods dispatch notes pre-year end and post year end to make sure that goods dispatched, if you like, pre-year end are, and then what you want to do is you want to kind of follow those through to the ledger to make sure they are in the year. And then you want to look at goods dispatch notes after the year end and follow those through to the ledger to make sure they are not in your year. And that's your cutoff. That's your cutoff. There's another balance that no one's mentioned. What else, Hannah? I'll come back to you here. What other balance is so connected to revenue? I talked about it earlier on that you must talk about.
Oh, I'm not sure. Sorry.
That's okay. I'll give you 2 words again. I'll give you one of the words. The first word starts with a C. I can't give you the second one because if I do, you'll know it straight away. James, you can help her. C. We issue them.
Credit note.
Credit notes. Credit notes. And they're so easy to forget. So, James, carry on. What is it about these credit notes that I'm interested in? Don't worry. I'm having fun. Don't worry about
Throw this one back to Hannah.
Wow, there's friendship. Hannah, it's back to you.
No. Oh, no.
Credit notes.
Is it what year they're sort of treated in?
Yes, correct. So carry on, Graham. So Hannah's nicely.
Thanks, Graham.
So yes, what year they carry on? So you're right. What year? But because I want to write it down, I need to be exact to the examiner to say, well, so carry on.
So credit notes raised should be accounted for in the year that they relate to. So
that's perfect. So carry on. No, you're right. So you're right. So you're not wrong. What you want to do to the examiner, you want to say credit notes. You want to look at a sample of credit notes
Post year end.
Post year end. Are you with me?
Yeah.
Oh yes, yeah.
In the current year.
Exactly. So you want to look at a sample of credit notes post year end to see that if any relate to revenue or sales made pre year end, that they have been reversed. And that technically, and really what we've done there, and we haven't even talked about analyzing. So so again, just because again, from marking and from this experience, we haven't even talked about the price promise yet that they've asked us, and we're already getting full marks. So how you notice a student a weak exam paper, or when I say weak, one that might just get the 50 from one that will get the 50, is because most students who haven't kind of done a lot of questions in audit will tend to still come to audit with a financial accounting head. So naturally, they'll come with analysis straight away because it's kind of like it's your go-to place. It's a safe place, right? I'll analyze it too, and in a way you can. It always reminds me of sorry, I don't mean this in a nasty way, but when I meet fancy directors who don't really know what's going on, and then they just say a lot of fancy words, we've analyzed and we've looked at the probability, and they just say all these things all really quickly, and they don't actually really know what's really happening internally. You're thinking, right, yes, of course, but what you need to do, what the examiner is looking to see, is that if you state to him clearly those assertions of, I actually know what it's like an interview. I know what I would physically do for occurrence. I'll do a walkthrough. I know what I'll do for accuracy, kind of like I'll take a sample and actually recalculate discounts. I know what I will do for cutoff, which is a very annoying thing, because with cutoff, you have to talk about goods dispatch notes pre-year end, post-year end. Then you have to talk about credit notes. I mean, you have to the truth is, you should really do a sample of credit notes anyway, just to see generally in the year. But what you've talked about, Graham, is you did cutoff for sales invoices or for goods dispatch notes, but you should also do cutoff for credit notes. So there are technically two cutoff tests we should actually carry out, but we should actually just look at credit notes during the year as well, if you like. So we should do a walkthrough, kind of like at what Natalie had said. Should do a walkthrough of credit notes anyway to make sure they have been reversed from the sales invoices. Right, great. And then, I mean, I think this question was 5 marks. You have, and I still haven't even talked about analysis. Then you come with your analysis, if you like. And remember, with analysis, I was highlighting the need to even break down the revenue streams and then analyze one and then look for fluctuations. Right, okay, great. Now, let's come to this price promise, because it's a problem. We can't ignore it. Hannah, how did you tackle this? No, Hannah, I'll go to James, because James very nicely, and sorry, James, you can't send it to Hannah, this one. How did you look, or what did you think what would you do about this price promise business here?
Look at the claims made and compare them to the date of the recent live.
Perfect. Actually, you pick up on 2 points. Let's first of all, look at the claims made. First of all, there are a number of conditions so just pre what James was saying. I know it sounds like a niggle, but it's important. You first of all always want to obtain the list of the people for completeness, because you see the question says you always want to obtain a list. I guess this is the nitty-gritty about audit, just making sure you satisfy. Then what am I looking at here? This is the list of all the people who made these claims. So and then, like as James said, you want to then back up or see whether or not their claims are valid, because it says they had to, I believe, prove that, yes, it says they were able to prove. So you want to see to what extent which is why I'm saying that with these audit questions, you just have to react to the question. We're not going to see in the textbook this type of, you're just acting. Want to see that the people did truly find a better price somewhere else, and then they were then given the. We want to see the process of going through that, to look for that. Now, James picks up on another point. And of course, the next thing, of course, is verifying that it was done within the 1 month. That's part of the process, the proving of that point. Okay, so I'm going to throw this back to Dudley. So do we have a cutoff issue here with this dates and the price promise, technically?
Yes, because you could obviously reclaim over the course of the year end.
Perfect.
And
yes,
it's about the fact that it shouldn't really be for a month, it should be on date of purchase.
Exactly. So what we have here is that, imagine you've made sales in December now, and December is the year end, and post year end, maybe in the month, you now have all these claims. Now, again, these are adjusting events. These claims relate to your year end, so you cannot ignore them. You have to readjust your revenue to also deal with these post-year end claims, because the person has a month to make this claim. So in a way, it's a bit like a warranty provision or a guarantee provision or whatever it is. That's what you've one thing you have to deal with. Then, of course, it says there's a refund liability of 0.25, which is based on the monthly levels to date. So, I mean, just for language, Natalie, what did you think of this 0.25? How did you try and rationalize it?
Is it to say how are they going to account for it in the financial statements? Would it be a provision? Or?
Yeah, it'll be a provision. So what are you really testing? You can see we talked about accounting estimates in a way. What are you really trying to see? You're looking at the reasonableness of this provision. I mean, it says the company intends to. So we can have evidence of what to a certain extent, what the actual repayments have been. Do you see what I mean? Because you will have over the year, you would have been, if you like, actually paying money back to these customers who have come back with a price promise. And imagine, so far, it is you had paid back at the year end, just before the year end, you had paid back. I mean, to be fair, is this a new? This must be. It says it's a new initiative, isn't it? So imagine, because that's why we're putting through a provision. Imagine we started halfway through the year, and so far we have paid back 500,000, 0.5. So definitely, this provision is not enough. This provision needs to be increased, and so we need to kind of test the reasonableness by comparing what they think it'll be to what payments they've made so far. And then we also have post year end. So I know I'm trying to bring it really down to the core level to push you to see what it is. But the big points. So let's go to the answers and see some of their answers. Right, and then see, so you can see, and they have more things than even I have, but I've just kind of picked up on the there are still full marks for the analysis. The question of you guys talking about analysis, full marks, but again, you want to show the examiner, and hopefully you see here. So they actually start off with analysis. Okay, that's fine. Sorry, I'm thinking like in my I'm thinking through the I should look at these sometimes. I'm thinking through the audit program before we get to analysis, but very good. Okay, great. So like we said here, compare the overall level against this perfectly, literally almost like these are perfect answers. You cannot get, they're perfect answers. Analysis 100%. Great. So we talked about proof in total. This, I didn't even mention that. All income statements. So this word, please, I mean, I'll keep asking and keep getting you to do questions on it. Every income statement balance, we must also always apply a proof in total test. What does that mean? I literally carry out a calculation on my own to what I think it should be, comparing it with what it actually is, if you like. So for example, for revenue, it might be what I think the average price should be times the number of products, and compare that to what it actually is. You know, you could really just think of it that way. Here they then break down sales into different categories and compare prior year. Look at that. I suspect the examiner might be cautious in giving you all the marks purely on analysis, I suspect. And then gross profit margin, kind of like what James said, they might want to see you actually doing some real tests, you know, because ultimately it is still an audit. Pure analysis isn't going to fulfill substantive, you know, substantive tests, really, because there's a quite hands-on practical tests. So this is in terms of accuracy, kind of coming back to what to what Hannah mentioned. What you want to do is you want to. I always forget this one, to be honest. There's too many of them. In terms of accuracy and occurrence. So they've asked, Hannah was like, select a sample, recalculate the totals, including discounts and sales taxes, literally just for pure accuracy. Then there's another one here, select a sample and agree to the price list or to ensure the accuracy of the invoices. So this is the actual, because you remember our systems actually generate the invoices. So just to be sure that the invoice is actually churning out what the internal information is actually saying, that's fine. This is what I was talking about, the credit notes. We cannot dissociate credit notes. You will never see an actual heading called credit notes. No, you must remember, and they're separate marks. So we have one straight away when we mention, we deal with revenue, and then we deal with credit notes. You're done, you're through, it's over. You know, you're done. So credit notes, like I said, not only at the year end, but I want to see whether or not these credit notes are being removed from sales. And you will get an extra mark for talking about credit notes post year end again. This is what we were talking about earlier on. This was Natalie's walkthrough. Start with the orders, dispatch notes, sales invoices in the day book, and go one step further post year end. Well, payment, of course. This is what I was talking about, a cutoff, dispatch notes, pre, post, and follow through to the sales invoice in the correct accounting period. So we're technically done with all the standard tests. Then we come to this promise, and I actually think with the price promise, as long as you explain it in your own words, I don't really think, because it could be another question tomorrow, who knows? You're just dealing with the problem and saying, well, I want to verify what's going on here. So this is what I was talking about. How reasonable is that? Are these claims? And for a sample of sales invoices between June, oh yes, I didn't even think about that one. I mean, again, it's just reacting on to look at the subsequent credit notes. So you can see there are a number of points there that we even mentioned that aren't on there, but you would get marks for. I went for obtaining the list, looking at the claims, verifying the claims, if you like, the accuracy of the claims and recalculating some of them. Cool, great stuff. Right, let's go to the other bit. The second bit was on inventory. Sorry, let me just come back to that question. Then we had this problem here of this mix of materials, and you had a number of complaints about the paint consistency. So for one particular product, and it says that further sales have been stopped. We have a product recall for any of these specific paint products. So just really think of yourself in the factory. We might have answers that aren't even on the scheme, but just think about it. I'm sitting here. I've got these paint products that have gone out. They've been sold. I have complaints from customers about consistency. Have already been sold in the issue, and the issue was identified following a number of claims being incorrect. So we've stopped sales and a product recall, and we're investigating whether the paint consistency of the faulty products can be rectified and subsequently sold. And the question for 3 marks, again, I think you will pick up all 3. I really don't think there are too many issues here. Again, like all things, I should keep reminding you, we're looking at the question of assertions. So typically the assertions here are about, of course, existence, accuracy, valuation. I think that's where we're going. So let me just get your thoughts. We'll go to the answers, but again, I think you're fine. I'll start off this time. I'll go back to Hannah here. Hannah, what were your thoughts on this? How did you seem to tackle this?
To get a breakdown of the damaged goods and the inventory.
Perfect. Yes, thank you. So we'll start off with that, and you're there. These are lovely key words that you've escaped. Obtain a breakdown of the damaged goods that you have in inventory. Let's be clear. Where are they? Let's see a breakdown. Very clear breakdown of that, and that's your starting point. All right, James, where did you go next? Where could you have gone next?
I said to see if the damaged goods can be repaired and the cost of the repairs to see if they'll be sold on.
Yeah, exactly. Yeah, I think that's really that's what you're really asking. You're inquiring. But let me push you. Why are you just to finish that? why are you going through that whole, what is your end goal ultimately? What assertion are you ultimately trying to prove or question this? Oh, if you repair it,
The value of the inventory.
yeah, the value, because ultimately you're going to pump all this money into this thing, fix this thing, but we must be very clear that goods can only be recognized at lower cost and net realizable value. So I need to know that whatever you're doing, you would only recognize this at the lower of. So if then, like we say, we don't, can you sell them on? Are you selling them on? How much are you selling them for? I can see you're selling for less, so we must recognize them at the lower, which is net realizable value. Good. I think there's a that's where we are. Yes. Natalie, any you have any? There was one or two more things that we could go with, but
I need sort of documentation of the costs involved, maybe.
yeah, yes, exactly. Yes, the documentation of the costs. And let's not forget, there is existing stock. There is existing stock. So probably there's existing stock. So there should be a consideration of the value of that existing stock. Remember, we have goods coming back, and then we also have goods that we have existing stock. So we have goods that we have goods coming back, and we also have existing stock. So to do the write down, yeah. I mean, I haven't looked at the answers. I will see that in a second. Graham, any thoughts here? It says customers aren't happy. Yeah. There's not a lot there. Potential litigation. We should ask questions. So fair enough. It doesn't. It might not be inventory, but you will get a mark for at least asking the question. Has there been any damages as a result of this? So you're always asking, are there any damages? Are there any potential? We don't know what's happened now. So you want to be examining the board that you probably would have picked it up in the minutes, any board minutes, if there had been any sort of issues that clients weren't happy with.
Is it worth because it just says management is investigating whether the paint, so they don't actually know whether it, so should the auditor sort of push for an answer for them?
Yes. We want to inquire. We want to inquire of management, exactly. Because I know this is an exam question, and we don't know a lot, and I accept that. But here it says here. Sorry. Where was I? Yeah, here it just says that, like you said, management are investigating, can be rectified. So yeah, so the fact that they're investigating, this is what James was alluding to, and we want to basically review that documentation as to whether or not the value will be recognized in the lower of cost and net realizable value. But further on, we also want to ask about regarding this question of potential. Has there been any letters from any of these suppliers? And so ultimately, what effect would be the overall existing cost of these faulty products? Let's go to the answers and see what they have. But for 3 marks, to be fair, you can only there's only so much scope. So yes, Hannah started off telling us to obtain a breakdown of the damaged goods held in inventory. You can't go wrong with that. Let's actually see what's going on there. So they give you a number of things. Again, like I say, these are the kind of things that you'll pick up on as you're looking at the answers. So because something that I didn't really pick up on, but I highlighted when I was speaking, was to do with the just verifying what's going on in terms of the actual sales, just getting the amount of goods that have been sold, just getting that and linking that to the sale. So if you like, agreeing the damaged goods since June to production records and agreeing that to the sales records, that's fine. Agree on a sample basis the returns to confirm the existence of the returns. Okay, yeah. Of course, goods did come in, so we actually want to, but we have that breakdown of, I think there's I almost felt this kind of covered that topic, because because we want to get a list, a list of the breakdown of the damaged goods held in inventory, and also a full list of the customer returns, if you like. There we are. And I think there's, fair enough, because it's focusing on inventory, there might be some more returns that we're expecting. So we might need a provision, to put in a provision to deal with that, to take that off sales. So you guys then went on and said, I think that was James, discuss with management the current status. Can you rectify it? Can you sell it on? What is the cost? And you talked about supporting documentation, Natalie. If it's been rectified and sold, agree the sales invoice to assess net realizable value is in line with the new cost of the product. So this is pushing on further to ask, you might not say it in this language, but we basically want to look at post year end. Probably I would have said I would examine post year end sales to the cost, if you like, of rectification and product to ensure that it is recognized. This is another one. I mean, again, I didn't pick up on this, but we can't forget that they're making these products. And generally, you would talk about this when you're making anything. So you want to look at the supporting documentation to do with, especially products that are made, the standard cost in effect, or raw materials, labor costs, and any overheads attributed to the cost. So this is what I was talking about, this question of writing down things. In a way, it feels like we've said it, but you want to break it down literally. So if you're writing down these costs, we actually want to see the write down. We actually want to see the write down, and you're always inspect monthly board minutes just to obtain any further information regarding faulty paint. This might be whatever information here. Information is an open word, isn't it? An open word. So it might be to do with litigation, just to do with resale values, that sort of thing. Cool, great. Yeah, I think this is good. I think what we're doing now is starting to take the theory that we've learned and understand that it's quite uniform, in that our first task is always to, I don't think it matters, kind of like, we didn't carry out any analysis. So generally, it doesn't really matter whether you start with analysis or start later on with analysis, but I think starting off with, maybe that's just personal preference, starting off with obtaining the list of what it is you're interested in, and then actually carrying out either walkthroughs, occurrence tests, completeness tests. When I say walkthroughs, I mean completeness tests, occurrence tests, cutoff tests, mentioning that those right words, goods dispatch notes or goods received notes, show the examiner from the onset that you know what you're talking about. Then you move into analysis, and then you start, and then your work just builds. Although, to be fair, you might have carried out some analytical work at the beginning to give you some indication if there are any fluctuations anywhere. And when we talk about analysis, there are at least four marks in analysis. Yes, there's an overall analysis, but there's a breakdown analysis, literally breaking down all the items and then analyzing item by, when I say line by line, product to product, to then look for significant fluctuations and looking for anomalies. Will help. And then all the other side issues of credit notes and things like that, especially with revenue and even with purchases returns, things like that. So those are all there. And then of course you get the lovely marks at the end where you're always inspecting the board minutes, discussing with management. So once you have that particular structure in your head, you kind of know what to write after, then you can kind of apply it or make it relevant to the question, but you know what you're looking for to start off with, and you start building your skill of dealing with these questions, especially with these audit procedures. Okay, great stuff. Right, so we won't, yeah, I think this is a good place to stop. What I recommend is that please have a go at, you might have, if you have, thank you. I mean, I'll check my box and I will mark. So I think I asked you to do Darjeeling. I think, I can't remember the middle one I asked for, but really you should start doing a lot of these. But the other one I definitely wanted you to do was Recorder. I think it's 1.6 something. I think that's a good question to do. So if you do that, and all these questions in between, basically everything from 151, you literally can start working on them. Just sit there and just, and kind of sit and just do the writing. I also think that then I think that I mean, you know what? I have a few. I guess I have a few minutes now. Let me just check on my page to see if I actually have. 1 second. Let me just check, so that even if you don't have. Oops, sorry. Even if you don't have, let me go to my channel playlists. What you can, even if you don't want to, even if you don't have time to, here we are. Let me just come here and just do, right. So, yeah. So, let me just share my screen, new share. So, on my page, if you go to playlists, oh, sorry. There's two people talking. If you go to playlists and you go to the Audit and Assurance Question Bank C, and I'll just go there, and I'll just pause. And you can see here that I believe that the questions might have shifted a little, but literally I do a number of questions. And what really made me do this was Holly, who I think she did PM with you. She was doing audit in the summer of last year. So we had to kind of do some work together. And so I ended up recording a lot of the answers. So I think you should be able to, you can find out. I mean, I will check later on to see whether or not if there's been any change to that. But you can do a question and you can look at the answers there. So so yes, please. So please do everything there. All the questions in between what you're seeing, 151 all the way to recorder. Well, when I say do all of them, do recorder. I think it's 16 something. And we will carry on next week with just keep doing them and reviewing, and then we will carry on with our next chapter, which might be reporting. Actually, let me just see. No, completion and review. So we'll start talking about completion and review next week. Yeah, cool, great stuff. Is that good?
Thanks, Ian.
No problem.
Thank you,
Yeah, thanks.
Ian.
No
Thanks,
worries,
Graham.
Thank you.
guys. No worries. Have a good weekend.
And
And you.
Cheers.
See you later.
Bye.
Bye bye.